Charles Schwab Chief Investment Strategist Ann Sonders joins us now. Ann, great to see you. My first question, big picture question, if we just heard from Steve Leisman before the break, if 3 rate cuts don't indeed materialize this year, does that derail the equity market? Because I guess we've adapted from the expectation of 5 or 6 down to 3 and markets up 10% year to date.
Right, exactly. And I think that's the important question, because the market has adapted as we went from not just a March start, but, at a peak 7 or so rate cuts. And the data just wasn't supportive of that. And the Fed had to push back. But the market has been fairly resilient. You see a lot of movement under the surface, though. And I think that is a function of changing expectations around Fed policy, movements in bond yields. It's really caused some shifts in leadership more toward the cyclical end of the spectrum, with sectors like energy and materials and even financials doing well in terms of shorter term breadth measures. So I think around those expectations of Fed policy, even if they become milder in terms of what cuts are expected, you could continue to see rotation under the surface driven by some of those moves.
Are you worried about election political risk for equity markets, or in fact was the sort of last significant political hurdle sorted over the weekend?
Well, I think it has the potential to be a volatility driver. I'm stating the obvious here, but this is going to be an emotional year as it relates to the election. And it's, one uncertainty that sits alongside the uncertainty with regard to Fed policy. It's probably not a stretch to say volatility could pick up, in part because it has been so suppressed. When you go through an extended period of low volatility, you're at the mercy of potential catalysts for a pickup in volatility. And I would easily put the election in that mix. Of course, the real issue, though, is as we go through campaign season, hearing what's proposed on both sides, the likelihood of those proposals actually turning into policy is likely to be limited by divisions in Congress and majorities, regardless of what happens with both houses, that are likely to be fairly narrow.
When you look at where sentiment is at the moment and the main indicators you focus on, is it flashing red or just amber? And either way, would that trigger a 2 or 3% pullback or retrace much more of the 20 to 30% gains we've seen since October last year?
Sentiment is no doubt on the frothier end of the spectrum. But we all know that sentiment at extremes often serves as a contrarian indicator. The timing associated with that is incredibly variable. And I wouldn't suggest anybody look at sentiment, either when it's overly frothy or overly dire, as some sort of moment in time trigger for a contrarian move in the market. It's really just, it's a condition that then establishes maybe a bit more risk on the downside to the extent there's some sort of negative catalyst, as opposed to it being a trigger for trimming or selling simply because sentiment has moved into frothy territory. We all learned in the late 1990s that sentiment can get frothy and stay there for an extended period of time. So I think you still would need that negative catalyst, not just sentiment in and of itself acting as a condition for a move down.